You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
We have all been programmed to be careful that after a run, we have a collapse. The most difficult thing for the people like you and I that have been in the market for quite a while is we are going to be tempted to sell too early.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me I have Claude Bejet, who is a longtime sector investor and editor of the Swiss Gold Letter. In our conversation today, we will discuss the current gold market, optimizing your portfolio for maximum gains, and a few of his top picks. But it's great to have you. I think it's best if we start off with an introduction to yourself and the Swiss Gold Letter.
Okay, well, look, I majored in one of the best business schools in Paris, but I also have a bachelor's degree in philosophy, psychology, and sociology. Probably the psychology was my best training here. I worked in marketing and advertising for quite a long time, and I've been speculating for my own account since '87. And since 2008, I've specialized in an area which it's a little complicated, as we all know, which is the junior gold mines, but with all the ups and the downs.
Right. And so the experience that you had, or I guess your educational background and stuff you learned in life, was that more of an impact on you than the experience of actually being an investor in the sector? Because as you said, the junior mining space is something in and itself different from the rest of the market. So what did your background prepare you for what you were about to enter back in 2008?
Yeah, probably not. It's just, it's your experience in the market, the very smart people you meet, the books you read, the directions you have by great investors, or watching how the best CEOs in our industry, how they do, what they do, things like that.
Right. And when did you start writing the Swiss Gold Letter?
That's just a side thing. I'm really speculating for my own account. It's not a real newsletter. It's just a way to communicate to I'm very fortunate because I have a lot of friends in the industry who are among the best gold fund managers and stock pickers. It's a way for me to have a way to exchange ideas, really, more than anything else. It's a free newsletter. It's not like Brian Lenny, who has a real newsletter, It's a free subscription. I'm not here to sell anything. People know I'm independent. That's it.
Excellent. And so in terms of like when you came into the market, obviously, by your publication or your interest, precious metals has always been the focus, or have you branched out into other things?
Yeah, no, I did a lot in emerging markets because a friend of mine was the best fund manager in the area. He had a 5-year track record. We had done better than George Soros and all the big guys at the time. So I did a lot in emerging markets. I'm very close to Mark Faber. We went together in Peru in '93 when there was the Sentido Luminoso blowing up people and cholera in Lima. At that time, I tell you, there were no bankers running around, and we were able to buy Buenaventura, the best silver mine at the time with the best geologist, an old timer called Buena Vista. We bought when the market cap was $12 million. I mean, we didn't have too much research to do. The market cap was cheaper than the cost of their fleet of trucks.
Wow, that's incredible. So, over the period of time that you've invested, has the market changed that much? The way that you see investors participating in it, how much different is it over the last couple decades?
The old timers will tell you it's always the same thing. People get excited and then people get depressed. Markets are manic depressive. Okay. So the trick is to buy when everybody is selling and to sell when everybody's euphoric. And this is easier said than done, as we all know, because even when the market is very low, it can go lower. That's one of the mistakes I made in 2015. I averaged down too early, and that was not too good for my portfolio. So things are not getting easier, but, well, yes and no. because the advantage of experience is that you've lived through that. So you know what a bubble is, and you know what a cheap market is, and you're more relaxed about things. So it's easier for you to get in and out. You'll never get out at the top. You'll never get in at the bottom. You know that. So you have a different approach. So you're the guy who's changing more than the market. Maybe that's the answer.
Right. Oh, that's a good way to put it. You're based in Europe. I was wondering, a good question. I guess it's based off my own sort of bias and my experience, but are European gold investors different than North American gold investors?
Yeah, people are people, so they're more or less the same. It's the same psychology, but here and then you have some differences. So let's say today in Europe, people are not interested in gold. They're not interested in gold mines. So it's just the same thing as everywhere else in the world. Maybe there's a little different touch in Germany. They have lived through hyperinflation, which, as we all know, created World War II. So they have a real understanding of what hyperinflation is. So even in the worst times for gold, they were still buying some physical, just adding. So there are some little differences. Paris used to be very buoyant. They had a huge markets for mining, but they lost interest, and now there's practically no more mining stocks quoted in Paris. So now Germany is certainly more buoyant than Paris for our industry. In London, there's a lot of very smart fund managers. So here there is more interest for the difficult game we're playing.
You talked about Paris and how they sort of lost interest, and I'm sure it's the same across different smaller exchanges across Europe. Do you foresee this, whatever we're headed towards, if this indeed is another precious metal bull market, do you foresee that changing where these other exchanges or mining becomes a bigger deal in Europe and, more investors do become interested?
Yeah, absolutely. Fear of missing out is propelling NVIDIA and all that to stupid levels. We probably will have the same thing with our senior gold producers.
Right. Question for you. Does the quality of a junior mining investor's network correlate to their success?
Well, sometimes knowledge is not an advantage. So if we are, as I think, really entering the heart of a big bull market in junior gold mines, maybe I should give my portfolio to run to a 20-year-old who has no fear and no experience of a loss. but it's a difficult question to answer, really.
Okay. Well, I just mean the more my network of people that I know in the sector has grown, the more opportunities I've had to get into good deals. That's
absolutely correct. Where I'm very fortunate is that since I just run my money, I have a lot of time to research, and I have a lot of time to communicate with people who are much, much more knowledgeable than I am. And I can piggyback on their ideas, or I can check their ideas. So that's a huge advantage, because our sector is, you need so many skill set. Nobody has at the same time, a good knowledge of geology, a good knowledge of metallurgy, a good knowledge of political risk in Peru or Congo, and a feeling for market psychology. I mean, these are nobody has all these skills. You might be very good in one area, but if you don't match everything, so the networking effect, Lenny, Brian, you're really right. This is really important. But the most important is your own psychology. So basically, the only advice I can give to your viewers is to try and find, to understand your own psychology and to work out a system which is aligned with it. So, for example, I like to buy cheap, okay? Well, so I like to have good deals in hotels and this and that. Okay, so I had to adapt the way I invest to my psychology and not the other way around. So I think it all starts with your psychology. It's you in the market. That's I think how it works. So you have to work out something where you feel comfortable and where you can sort of understand your risk reward profile and things like that.
Do you think that there are certain personalities that shouldn't be in maybe the stock market, but maybe more importantly in the junior resource sector?
Yes, probably 95% of people should not be dabbling in this market. The statistics are horrible. You to be successful. I mean, I don't know many people who have been successful in the market and who are purely independent and just speculate for their own account. It's a game that's psychological. I mean, it's not complicated. It's not rock science, but psychologically, it's not that easy. So it's an easy game, but most investors, they get caught up in greed and they make stupid decision. And then the markets collapse, and then they're scared, and they sell at the worst time. So I would advise your readers who don't have the stomach, but I'm sure some of them have. But those who don't have the stomach, they just find a good money manager, and they buy a gold fund, and they'll be fine.
What about conferences? Do conferences play a role in how you find new investments or meet new people?
Yeah, that comes back to your first question. I think your network and feel. I go to conference and then I feel the market. That's very important. I give you a real example. Just a couple of days ago, there was the Rule Symposium. I was too lazy to go there in person because there's the jet lag. It's too hot in Miami. If it had been the winter here in Lausanne, I like to go where it's a nicer climate. But anyway, I went online. Okay, so what happens? I got bored because I was listening to one speaker after another speaker, and I've been in the business for quite a long time, so I don't learn a lot of new things, so it can get quite boring. Nevertheless, you pick up something. So there was this exploration panel, and everybody was saying, "Don't go into grassroots exploration. Exploration is too complicated." They were negative, most of them on average. Okay, and these guys were good. And then on the other hand, Rick Rule at PDAC was starting to say that for the first time he was buying exploration companies because they were cheap. And Prescott Asset Manager, they have the best track record of all funds since inception. And these guys, they are buying exploration. So you see you go to a conference and then you feel these differences. Most people are negative, and then some really smart guys are all in. So it's by understanding these little psychological bias that sometimes you get ahead.
As a European, are the European-based conferences, like I can think of SMI, One-to-One, Minds and Money have some stuff in London, Zurich. There's got to be some stuff in Frankfurt too. Are the European conferences enough, or like you said, you did attend Sprott virtually, but for a European investor or the European viewers, should they be going to PDAC? Should they be going to some of the other events?
Absolutely. When I go to PDAC, when I go to Beaver Creek, when I go to the Colorado Spring from the Denver Gold Show, all these conferences are fantastic, and they're practically no Europeans. I mean, these guys, it's unbelievable. A lot of these so-called European experts, that run gold funds and who brag all the time, and they don't go there. I don't get it. Because that's where I would never have been able to survive without talking to you guys on the other side of the Atlantic. That's for sure.
So we've had a great Q2 in precious metals, and I think for a lot of investors, they're at least hoping that this might be real. I was wondering if you could give us your view on the current gold market.
Yes, well, champagne. Look, it's been a fantastic run, okay? In December 2015, gold was at 10,050. Today, it's 2,080, right? It's practically a double in less than 10 years. So what are we complaining about? It's been a huge run. People are just sleeping. It's not only they're sleeping, is that the gold stocks have been hit time and time again. So so we're not too confident anymore, okay? But the reality is that this is a serious bull market in gold. Now, what happened? Just before PDAC, you had several peaks around 2070, okay? And before this conference, everybody was saying, well, look, the day we're going to go above 2,100, or everybody had its secret name, a secret number, 2070 and 2075, 55 or whatever. But once we were going to go above that, it would have been bliss, pure bliss. And what happened? I was at PDAC, we break out, and then everybody was saying, got to make sure it's the real thing. I'm waiting for confirmation, blah, 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 blah. So they were not investing. And what happened? Boom, we went straight up. And now we've had a period of consolidation between 2,200 and 2,300 for a couple of months, for 3 months. And boom, yesterday we break out. So congratulations, Brian. This is the right time to interview. It's amazing. This is another key breakout.
Oh no, I was just going to say, do you think so? Talking about the gold price, like I can definitely see what you're saying. What about the equities though? Because the equities seem to still be sort of lagging. Are you as confident with the equities?
Right. So everybody has been complaining that the mining stocks have not done well and this and that, but the problem is not that they've not done. The problem is the volatility. Okay, so we have these huge runs. And they pick up, they go up very quickly. Unfortunately, every time, boom, you get smashed. So every time a generalist is going to buy the gold mines, he gets hit. So it's not it's not a nice feeling. But if you look at the recent price action of GDX, it's up 50% since March. It goes very quickly. Now, of course, if you had talked to me in June, I was down because my portfolio was down 8%, right? It's a really volatile market, but I think this time is real. I think we're now going to enjoy a real bull market in these gold juniors. I'm saying that because everything is looking terrific on the technical level. So you have new highs on all the gold stock indices with major breakouts. You have the GDXJ outperforming GDX. That's always a good sign. What's really, really important is that the advanced decline lines are very solid. So this seems to be the real thing. And then finally, the most important thing, and I'd like to spend a little time on that, it's the gold to gold mines ratio, okay? So having a little historical background means you're getting older, so that's very negative, but it has a few advantages. Okay? So let's take this. If you take the ratio of XAU divided by gold, since in the 80s, 90s, and up till 2008, you were in a channel, okay, and it was more or less going from lows around 0.18 to a high of 0.34 or something like that. And it was easy to make money at the time, not like what we've experienced recently. Why was it easy? Because every time the ratio was down, it meant the gold stocks were down, but it also meant that gold was down. Okay, because when gold goes down, people also always sell the more leveraged plays, which are the gold mines. So by buying the gold stocks when they were at the low of the ratio, then you had a double leverage. You would have gold going up, and you would have the gold minings re-rating versus gold. So it was pretty easy. Even if you didn't pick the bottom and sell at the top, you had a lot of leeway. So that worked very well for decades. And then in 2008, the ratio started collapsing. In other terms, it went from 0.18 to 0.04. I never would have imagined that could have happened. It's extreme. Now, this means that there's something structurally wrong with gold mines, because or else we would have been in a cyclical trading range. So, of course, we all know what's wrong now. It's less big discoveries, cost increase, political instability, expropriation, tax increase, stupid bureaucracy, so you can't build a mine in a normal time, and all that. Now, this is in the market. Now, what is different now is that this gold mines to gold ratio has broken out, and the low was 0.04, you're around 0.07. I think this is significant. So from a very depressed level, you're going to have a huge catch-up phase. That's my firm belief. Of course, I can be wrong, but it's looking pretty good.
How about duration? As a full-time investor, I've experienced two gold-driven bull markets, one in 2016 and one in 2020. And the duration of those, really like the heart of the bull market or bull market portion, was 6 to 8 months. Do you think this is any different, or are we going to see something extended past 6 or 8 months, or is this again going to be another flash in the pan?
Yeah, that's a really good question. Look, last time we had a bull run, I thought it would go on straight, and I didn't expect a big drawdown, and we did get one. So whatever answer I will take with a grain of salt. But the level of pessimism is still so deep that I think this time we're going to have a big, much smoother ride. Historically, if you look at every time you've had a major breakout in gold, but of course you only had 3 examples as of today, but in all these examples, you had at least 2 to 3 years of good sailing. So I would expect to have less of these downside drafts. So I hope this is not just pure hope, but it would make sense because nobody's in.
How about binary question for you? And it's a gold price prediction. Will gold end the year above or below 2,600 US per ounce?
Well, you feel how bullish I am today. So I would say above 2,600 because, everything looks terrific. But, these predictions are not too interesting. What's more interesting maybe is to see the positioning in the market. So, for example, if you look at nobody owns any gold today. There are some buyers, of course, in Asia. Central banks are buying this, we know. But aside from that, nobody's in. If you, as for example, I checked what the Swiss banks were doing, okay, because they're more or less like most banks in the world. So basically, in 2011, the Swiss banks had 10% in gold. That was their asset allocation. In 2013, they all went back down to 0, and they have had no gold since. Now, recently, they're starting very slowly to buy a bit. So if you take Pictet on May 15th, they introduced for the first time a 1% asset allocation to gold, going to 3% over time. UBS, the biggest Swiss bank, the guys who bought Credit Suisse, they introduced a 2% allocation in June. Lombardier and other big private banks, now they have 3%. So, but these guys, they traditionally, historically, they always had 10%. So you see, there's room to grow. And then nobody that I know has ever recommended gold stocks in the traditional, why would they? I mean, they're making so much money with Apple and with NVIDIA and so on. Why would they invest in things that go up and down all the time? Right. So there's a true reason.
Do the U.S. tech stocks give you any trepidation in terms of risk for a crash?
Yeah, sure. It's it's a bubble, and everybody who was not smart enough to participate, they're on the sideline, so they know they stay objective, and they can see it's a bubble. So we know it's a bubble, and if you take just the normal valuation metrics, if you take the Buffett indicator, well, the U.S. stock market versus the U.S. GDP is at bubble territory. It's just like if you take the CAPE ratio, it was 30 before the 29 crash. It was 46 in the bubble of 2000, and now you're around 35. So we know people will not make money in the stock market for in the next decade in inflation-adjusted terms. So when the top 10 companies make 37% of the S&P 500, this is the signature of a bubble. Every time a sector has been so big in the market, it has ended in a severe bear market. As we're talking, the NASDAQ, so we're having fun and games with gold. It's going up. Today, the NASDAQ is down, I think, 1.7%. I think we've seen the top, and we're going much lower.
Does the risk for a bubble burst in the tech market force you to carry more cash in your portfolio, or is it something that you sort of doesn't affect how you allocate money?
Well, I should be more prudent, so I should have cash, but I'm fully invested in junior gold mines. I am not advocating that for the normal person. It's diversification is rule number one. But I'm young and dumb, and I'm going for the jugular. But you do raise an important question. So if you look at the statistics, there is a very good, if you have physical, it's a very good hedge against a stock market crash. In other terms, on average, when the stocks go down, usually gold behaves very well. There has been some exception. If it's a big crash and there's a liquidity crisis like in 2008, then gold goes down with the market, and then it rebounds quite quickly. But on average, it's usually a good hedge. Now, with gold mines, they have more of a stock market component. So here it's 50. So it's not that clear. I still don't, the reason why I don't have, so I have a little short on the NASDAQ to protect a bit, but I still believe that since the gold stocks are so cheap and the stock market is so expensive that, maybe we're in a situation where if the stocks go down, then gold stocks could still go up because things, are a bit different. The earnings aren't going to be terrific and so on.
Right. Claude, I think this is a good point. You're a stock picker. Why don't we go over some of your top picks?
Okay. Well, so first of all, for your viewers, so these are a few things that I'm investing in. I think what's important is to have a basket, right? Because any one stock can go up, it can go down. Okay, that's very clear. So my main focus today is in where there is, I told you I'm a value investor, so I'm doing just that. Okay, so where I see the most value is in the developers. Okay, so of course the big caps, they move up first. So the big producers, I recommended Kerr Mining. It has doubled. It still is still has potential. Recommended Equinox Gold. It hasn't moved much yet. You can still add to Equinox. They're ramping up a great deposit, Greenstone in Ontario, that will produce 400,000 ounces. I think this still is a reasonable bet. So I would say for senior gold producers, buy the laggards. One of the laggards is B2 Gold. I've added to my position there. You have one of the best CEOs by far of the industry. They have 4 mines. They're producing 450,000 ounces. Next year, they'll be producing 1 million ounces. And they're having their first gold pour on their Goose project in the second quarter of 25. That's a great stock to own for the long term. But again, the key area to concentrate in, where you'll have a lot of 10-baggers, is in the development companies. Why? Because we're in a schizophrenic market. I mean, on the one hand, you have Equinox Gold that bought Orion to get the 40% they didn't own of their Canadian deposit. So to buy 160,000 ounces of production, they spent $1 billion, and everybody found that was terrific. Okay? Now, if you compare this with the value I am seeing in development companies, even those with permits, it's amazing. So just to take an extreme example, Vista Gold, it's in a safe jurisdiction. It's in Australia. The market cap is $60 million, but they have feasibility studies. They have numerous studies, PEAs, feasibilities, different feasibilities over years. So it's a pretty well-known deposit. Measured and indicated 7.8 million ounces. They can produce 470,000 ounces of gold, 92% recovery. The mine life is very long. So of course they'll have a $1 billion capex, but to produce some near 500,000 ounces in a normal market, that should be easily financed. So $60 million for that doesn't make any sense, especially now they have a lower capex approach, a phase approach where they can start producing 150,000 ounces, and then the capex is only 350 million. So I don't think there's much risk there. In the same category with people who have permits, because nobody has permits, and analysts don't pay for it. Why? Because we're still in bear market psychology. So if you take Western Lake, it's their project when bankrupt three companies. So no analyst wants to recommend it. Everybody's smart. Everybody knows it'll never work. Well, I tend to disagree. At the peak of one of the previous company, the market capital was $1 billion. Today, with better management, better company, the market is $280 million. Price to NAV 0.23. The junior producer average is 0.64. They're putting back the Matson project in production. The former company spent $350 million for that. Now, there's They have the team. It's a Frank Juster company. They have the team. They have a great CEO who knows how to build mines. They know exactly why the mine went bankrupt. They're doing everything so it doesn't. They have the team. They have the money. It'll be successful. You have 3 catalysts coming up, a PFS coming. Once the financing will be in place, and it shouldn't take much equity, maybe even none, and then they'll be in production in 12 to 18 months. So that's a nice candidate. Now, if you go down the food chain, there's some development companies with great resources, but no permits yet. So here you also have plenty of interesting companies. One of them is First Mining Gold. The market cap is $120 million. Dan Wilson is a great CEO. They have 2 world-class deposits. One of them is Springpole in Ontario. The net present value is $1.6 billion with an IRR of 40%. It can produce 335,000 ounces. Now, I know this deposit quite well. I had 2 10-baggers thanks to Quinton Henning, who discovered this project. And Dan told me that he would get me my 3rd 10-bagger on the same asset. I'm still down 40%. Okay, so the jury is still out. But if you buy it now, it's very cheap. The other deposit they have is Duparquet in Quebec, 23 PEA at $2,200. It has an NPV of $1.1 billion, IRR 28%. So basically, you're buying this company for $6 of gold, a price of gold in the ground. $6 an ounce of gold in the ground. Today, gold is at $2,407. There's a mismatch. So in a normal market, when people will wake up and say, oh, gold's up, they'll buy. Because you see, what's crazy is that although gold has doubled, as we've seen in the last 10 years, some people say they're rich, but even those, they don't buy. They haven't bought yet. So that's why to answer your question, that I think we're protected for some time, because they have to buy. It'll take time. They'll be, fear of missing out will come, but later. Anyway, but of course today you'll listen to crazy stuff. I mean, people will tell you, oh, don't touch Springpole. It's under a lake. You can't build a mine under a lake. Okay, that's when the stocks are low. When the stocks are high, the lake is shallow. You can build some mines. No problem. Okay, another stock I like a lot, Troilus Gold. On June 28th, they came up with a feasibility study, and the stock collapsed because it was a bit disappointed. So the stock went from 84 to 37. I'm more interested now because it's 37 cents. The market is only $120 million Canadian. They have 11.2 million ounces. At $2,300 gold, the NPV is $1.5 billion. So you see here again, you have a huge discrepancy, and they're going to have the lowest total cost, all-in sustainable cost, one of the lowest costs in Canada. Permits should come in 26. So you'll have an automatic re-rating on Troilus. Liberty Gold, Cal Everest is back as CEO. He's a great marketer. Market cap is only $160 million. It's a past producing open pit heap leach operation. It'll be a mine. The resource is 3.2 million ounces. They'll be coming up. There are going to be plenty of news. So the stock, which has started to move, is going to move further up, in my view. There's going to be plenty of news. They started a 20,000 meter drill program just now, and they'll probably have a PFS by the 3rd quarter and permits in 26. So of course, there is also huge opportunity on the exploration side, but these are, here you have to have a diversified portfolio. If some of your viewers want to go to our website, Swiss Gold Letter, I interviewed Quinton Henning in February because I saw the opportunity So he has great ideas. He's a much better geologist than I am. That's easy. So you might have get a few ideas there. Recently, I did 2 placements, one in tectonic metals at 6 cents and Barksdale resource at 15 cents. They're at all-time lows. So there's plenty of opportunities in this, but don't go overboard in exploration because it's a difficult business, as we all know. And sometimes we get it right, sometimes we get it wrong. So these are some of the stock I would concentrate. Development companies.
Excellent.
Because the valuation is crazy.
I think that's sage advice. I too like that section of the market, and it's something that I concentrate on. Claude, it's been a great conversation. You mentioned the Swiss Gold Letter website. Do you have a Twitter handle or LinkedIn or anything else that people can follow you?
Yeah, no, I'm not too much in that. You just go on the website and you have all the history, so you can see things that worked, things that didn't work. Everything is there. It's easy. It's a free newsletter. If you want to subscribe, just fill in your email. We have all been programmed to be careful that after a run, we have a collapse. The most difficult thing for the people like you and I that have been in the market for quite a while is we are going to be tempted to sell too early. So I think that's going to be just let your profit run and don't sell too early. That's going to be the big challenge for the people who've been around quite a while. So if you know a 20-year-old with no experience, give them all the money and wish him good luck.
That's right. Okay, it's great talking to you, Claude, and we'll do it again soon.
Brian, thank you very much. Bye-bye.